Welcome back, CMA candidates. I am so excited you're here today because we're finally hitting one of my absolute favorite parts of the syllabus, reporting organizational segments. We've tackled the who with responsibility centers, the how much with transfer pricing, and, the pure math with contribution margin. But now we're tying it all together. This explainer sets the stage for our final module on accountability and transparency. It's where the theory actually hits the paper, showing you how to present data so the top decision makers can actually steer the ship. So let's kick things off with a really critical question. Is a profitable division hiding a failing one? Think about it. At its core, segment reporting is literally all about transparency, because if a company just slaps one giant consolidated net income number on their end-of-year report, well, that can hide a multitude of sins. You might look at that bottom line and think, wow, everything's great. But dive a little deeper, and you might find a highly profitable division is actually subsidizing a total train wreck of a failing one. And as management accountants, we just can't allow that lack of clarity. All right, here's our battle plan for today's explainer. First, we'll look at the transparency problem, then identifying reportable segments, tackle the fairness factor, look at evaluating segment performance, and finally, we'll wrap up with discontinued operations and exam strategy. Let's get to it. Section 1. The transparency problem, seeking the true health. Why do the big bosses actually need all this transparency? Well, to make the tough calls. Segment reporting breaks the whole company down into bite-sized, analyzable pieces to reveal exactly what needs to grow and, honestly, what needs to be pruned. We have to break things down to stop hiding those operational sins we just talked about. It's only by isolating all these moving parts that management can see the true health of the business and put resources where they actually belong. So keep that grow or prune visual in your head for the exam. It's a real game changer. Moving right along to Section 2, identifying reportable segments and diving into those strict GAAP rule. Now, you gotta remember that not every little cubicle in the office qualifies as a segment under GAAP. According to your CMA syllabus, a reportable segment generally has to check 3 very specific boxes. First, it has to engage in business activities where it earns revenues and incurs expenses. Pretty basic, right? Second, its operating results have to be regularly reviewed by the chief operating decision maker, or the CODM. That's the person deciding where the cash goes. And third, discrete financial information actually has to be available for it. If it doesn't hit all 3 of those, no, not a true segment. But wait, there's a catch. Even if a division meets those 3 criteria, we have to apply the infamous 10% rule to see if it's actually significant enough to matter. To be reported separately, a segment usually has to hit at least 10% in one of 3 categories. Number 1, its revenue has to be 10% or more of the combined internal and external revenue. Or, number 2, its absolute profit or loss is 10% or more of the combined profit of all segments. Or, number 3, its assets make up 10% or more of combined assets. Just hammer this into your brain. Revenue, profit, or assets. Hit 10% on literally any of those, and boom, you've got yourself a reportable segments. All right, Section 3. The fairness factor. Allocating costs. I can tell you from years of teaching this, allocating costs is hands down the most controversial part of segment reporting, both in the real world and, for sure, on your exam. We have to weigh easily assignable traceable costs against those common headache costs. Traceable costs are a breeze. If the cost is only there because the segment exists, say the electricity bill for one specific retail store, it's traceable. Easy. But common costs, things like the CEO's salary or the rent for HQ, those benefit multiple segments. They are massive headaches to deal with. So here is an absolutely crucial rule you've got to internalize right now. Write this down. Do not allocate common costs to segments when evaluating manager performance. I'm emphasizing this because unfairly allocating these common costs totally distorts the true segment margin. Think about it. If a manager literally cannot control a cost, they absolutely shouldn't be penalized for it in their performance review. That's just common sense, right? Let's make this a bit more concrete. Don't force a manager to pay for a corporate jet they never even get to use. If you take the depreciation and maintenance of the big boss's corporate jet and then just unfairly allocate a chunk of that expense down to some regional sales manager's division, well, you're artificially lowering that manager's profitability. It makes them look like they're doing a way worse job than they actually are. It's unfair, it's terrible accounting, and I promise you it's a trap you're going to see on exam day. Don't fall for it. Moving on to Section 4. Evaluating segment performance, the metrics. You see, there's a huge difference between evaluating a segment itself versus evaluating the person running it.
When you're staring down a segment report, you're basically trying to answer two totally different questions. If the question is, hey, is the segment itself profitable? You're going to look at the segment margin. But if the question is the manager doing a good job? Then you pull the controllable margin. As a CMA candidate, you have to know exactly which metric to grab based on what the exam question is actually asking you to evaluate.
But listen, accounting isn't just crunching numbers, it's about strategy too. A segment might show a positive contribution margin, but a negative segment margin. Basically, it covers its variable costs, sure, but not its direct fixed costs. So in the long run, it's bleeding the company dry. Normally, you'd prune it, shut it down. But wait, what if that segment is a loss leader? What if it's bringing in tons of customers who then turn around and buy your high-margin products? We call that the halo effect. The Codium might look at that bleeding segment and strategically decide to keep it around simply because of the halo effect it provides to the rest of the business.
And that brings us to Section 5, Discontinued Operations and Strategy, Exam Prep.
Let's talk about what happens when management finally decides to cut the branch. When the CODM looks at a segment, realizes there's no halo effect, and it's just bleeding cash, they're going to sell it. And when they do, that segment gets safely isolated into discontinued operations on the income statement. You absolutely must remember two things about this for the exam. First, it's always reported net of tax. And second, it is reported completely separately from continuing operations. We isolate it so investors looking at the company's core business aren't distracted by some deadweight segment that won't even be around next year. All right, here is your final battle plan for this explainer, straight from my own exam strategy playbook. Step 1. Watch for and then completely ignore allocated corporate overhead whenever a question asks you to evaluate a manager's performance. The examiners love to throw that number in there just to trick you. Just ignore it. Step 2. Always remember to apply the 75% rule when finalizing your segments. So what exactly is the 75% rule? Well, once you've gone through and identified all your reportable segments using that 10% rule we talked about earlier, you have to do one final massive check. The total external revenue reported by your operating segments has to make up at least 75% of the total consolidated revenue of the entire company. If your identified segments only make up, say, 60% of total revenue, well, you're not done. You have to go back and add more segments until you cross that 75% threshold. This whole rule just ensures that the vast majority of the company's operations are being transparently reported. So, as we wrap up this explainer, I really want to leave you with a question. How are you feeling about that 10% rule? Does the math of identifying a reportable segment feel a bit clearer to you now? Remember, segment reporting is all about accountability, making sure the right people get the right credit or the right blame for the numbers. You are doing fantastic. Just apply these rules strictly and you are absolutely going to crush this section on exam day. Until next time, I want you to ask yourself, when you look at a company's income statement, what sins might still be hiding in the margins? Keep studying hard, and I'll see you in the next one.